Gold prices have hit a record high today yet again. This year, the precious metal is up 18% already, and we're just 5 months into the calendar year. The yellow metal has outshined equities in India. Nifty has risen a paltry 3.5%, whereas both mid and small caps have delivered returns of about 12%. At 76,215 rupees per 10 grams in Mumbai, is this the right time to buy gold? Well, the opinion is divided on that front just as yet. I'll tell you who is saying what in just a bit. But all that glitters is not gold, quite literally. Silver, palladium and platinum have also enjoyed a strong rally this year. In fact, silver has outperformed gold, reaching its highest price in over 11 years now at 96,500 rupees a kg. So what's really driving this surge, and more importantly, will the rally continue? Let's dive in. One of the primary reasons for gold's rally over the past weeks is the expectation that US Fed might start cutting interest rates as early as September following lower than expected inflation data in the month of April. Currently, traders are pricing in about 70% chance of a US rate cut in September, according to the CME Fed Watch tool. This marks a sharp increase compared to earlier in the week. You might be wondering how Fed rate cuts boost prices of gold and other precious metals. Well, gold as a traditional asset class doesn't really earn interest. When the Federal Reserve cuts interest rates, it makes savings accounts and bonds less attractive due to their lower returns. This prompts investors to seek alternatives like gold, which is considered a safe haven. Additionally, lower interest rates usually weaken the dollar, making gold cheaper for foreign buyers and increasing its demand. Now, these factors combined together drive up gold prices when the Fed reduces rates. On a side note, the sovereign gold bond issued by Reserve Bank of India does pay an interest rate of 2.5% per annum, but generally, gold as an asset and metal does not bear interest. So, apart from US Fed, there is a crisis in the West Asia. Gold's status, as I said, as a gold haven was highlighted again after Iranian President Ibrahim Raisi's helicopter crashed in dense fog on Sunday. This incident added to the sense of rising geopolitical risk in the region, especially after a China-bound oil tanker was hit by a Houthi missile in the Red Sea over the weekend. Israel has also kept up its strikes against Gaza, keeping tensions in the region high. Elsewhere, increased military action between Russia and Ukraine also supported the safe haven demand as both countries launched strikes against each other over the weekend. Amid all the geopolitical and economic upheaval, Chinese consumers have turned to gold as their confidence in investments like real estate and stocks has weakened. At the same time, China's central bank has been steadily increasing its gold reserves while reducing its holding of the US debt. Adding to this trend is the Chinese speculators are now betting that gold prices will continue to rise in the near term. In March as well, the People's Bank of China, remember, increased its gold reserves for the 17th consecutive month. Last year, it bought more gold than any other central bank, adding the most to its reserves in nearly 50 years. So, should you get on the bandwagon and lap up gold as well? Or have the prices run up too much, too quickly, that it doesn't make sense to enter at the current juncture? The analysts are mixed on that one. According to Kranti Bhatini, equity strategist at Wealth Mill Securities, despite a bullish outcome, gold prices may consolidate in future. Meanwhile, Santosh Meena, head of research at Swastika Investment, expects gold prices to rally another 10% from the current levels. So make your choice wisely.